Hey everyone, welcome back to another episode of Money Talks with Njideka. Today we're going to deep dive into 3 popular investment plans for children's futures. UTMAs and UGMAs, 529 plans, and custodial IRAs. So if you've been thinking, what the heck is the difference between these 3 accounts? Which one is best for what I want to do for my child? Get a notebook, get something to write with, because you're about to take some notes. So if you are new here, this channel is all about empowering you and your family as you are on your journey to financial independence. I am dedicated to helping ambitious professionals like you navigate the complex world of finances. So whether you're planning for your child's education or setting them up for financial success, understanding these 3 accounts that I'll be discussing today is going to be crucial. Now, before I get into things, don't forget to like, comment, and definitely subscribe so that you get notified when I drop more insightful content. So let's get started. All right, so the basics. UTMAs and UGMAs are types of custodial accounts that allow adults to save and invest for a minor child. Their acronyms come from the state laws that put these accounts into place. So UTMA, UTMA, is the acronym for Uniform Transfers to Minors Act, and UGMA, UGMA, is the acronym for Uniform Gifts to Minors Act. UGMAs were formed with the idea that they would allow for the holding of cash and securities, also known as investments, in custodial accounts, while Uniform Transfer to Minors Act expanded the type of gifts that will be added to the account to include property and other transfers. Now, all 50 states give you access to UGMAs, but all except South Carolina and Vermont give you access to UGMAs. Now, we all know that not everyone ends up attending college, so these accounts can be used for any purpose, not just educational expenses. So this flexibility is a significant advantage of these types of accounts. But it also comes with a caveat, because when it comes to applying for funding for college, these types of accounts are considered part of the child's assets, which could potentially affect their financial aid eligibility. On the other hand, 529 plans are specifically designed for educational purposes, and depending on the state, they offer tax benefits for the donors. And for all states, they grow tax-free. Keep in mind, when used for qualified educational expenses, you won't pay taxes on the withdrawals. Now, unlike UTMAs and UGMAs, 529 plans have contribution limits, which are set by the states, but they don't impact financial aid in the same way that UGMAs and UTMAs do. Now, let's add another key player in the mix, the custodial IRA, which can be traditional or a Roth IRA. I'll first start with the custodial Roth IRA. A custodial Roth IRA is a tax-advantaged retirement account that is owned by the minor but controlled and funded by the adult custodian until the minor reaches legal adulthood. It is very similar to a typical Roth IRA for adults that we're all familiar with, but it's intended for children. The account offers some flexibility too, because contributions to the Roth IRA can be withdrawn tax-free and penalty-free at any time. There is no age limit. Even babies can contribute to a custodial Roth IRA. But the hurdle to opening this account is about earned income. It's not about age. The child must have earned income. So if a kid has earned income, they can contribute to the Roth IRA. Earned income is defined by the IRS as taxable income and wages, money earned from a W-2 job or from self-employment gigs such as babysitting or dog walking. The money contributed to the account can be withdrawn at any time. Distributions from the invested earnings may be taxed though as income and penalized with a 10% early distribution tax, or both. Again, because these are individual retirement accounts for minors, it fosters early retirement habits. All right, next, let's talk about the benefits and the downsides. So UTMA and UGMA accounts are great for their flexibility. You can use them for anything, right? We talked about from educational expenses to a down payment on your child's first car. However, again, they can affect the financial aid for your child if they're applying for funding for college. The other aspect of the UTMA and UGMA is that they actually become the child's property at age 18 or 21, depending on the state, meaning there's a transfer of control, which can be a double-edged sword, depending on the maturity of that child when they're age 18 or when they're 21. Now, 529 plans, they're fantastic, as we've said, for tax advantages and focus on educational expenses. But as I said, their use is just more restricted, meaning if the funds are used for non-educational purposes, penalties do apply. And also, their contributions might be a little bit lower than the UTMAs and UGMAs. But remember, these plans do not affect financial aid. So if you're taking notes, remember, UTMAs and UGMA accounts offer flexibility but can impact financial aid and transfer control to the child at a certain age. 529 plans with their educational focus and tax benefits are excellent for college savings, but they come with some usage restrictions. Now, custodial IRAs, they encourage long-term savings for retirement, but the money must be used for retirement purposes, limiting its immediate utility for other needs like education and first-time home purchases. Now, let's consider, how do we maximize these account benefits? So it's all about aligning them with your goals. For instance, you could use an UTMA or UGMA account as a guaranteed gift for your child, while you would be using the 529 as a backup for educational purposes. Now remember, the 529 plans are flexible, so if one child doesn't use it, you can transfer it to another beneficiary. You could even transfer it to an adult. Remember, it's not just for college education use. You could use it for private school expenses. You can use it for grad school expenses. Ultimately, if you transfer it from one child to another, you are teaching the principle of paying it forward, which is really cool. Now, you can add the custodial IRA in there, and that can really instill early retirement saving habits. So combining all of these accounts can totally create a strong financial foundation for your child's future. Now, regarding tax implications, so UTMAs and UGMA contributions are made with after-tax money. So the money that is contributed into it is never taxed again, while the money that is invested, now, while it's being invested, the gains and the dividends will be reinvested, so there's not an immediate tax consequence. However, when the withdrawals start, you're going to get a 1099 for those gains, meaning you might face some tax implications at that point. For 529s, the tax story is different. Contributions grow tax-free, and withdrawals for, again, qualified educational expenses are not taxed. So this tax efficiency makes 529s particularly attractive. But when 529 account holders use those funds in the account for non-qualified expenses, the IRS does impose a penalty. You'll have to pay income tax and a 529 withdrawal penalty of 10%. Now, tax-wise, UTMAs and UGMAs and custodial Roth IRAs follow similar rules because they both have after-tax contributions. However, with IRAs, the focus is on long-term growth, with the tax implication coming into play only at retirement. Now remember, custodial IRAs can be custodial traditional IRAs or custodial Roth IRAs. Now, if it's the custodial Roth IRA, contributions to that account is made with after-tax dollars and grows tax-free and have tax-free withdrawals at retirement. If it's a custodial traditional IRA, it provides tax deductions on contributions on the front end, and upon withdrawal, it is taxed. All right, so how do you choose the right account? So let's consider 3 scenarios. 1, for flexible financial gifts. If you want to give a gift without specific purposes, UTMAs and UGMA accounts are ideal. They allow the beneficiary to use the funds for anything from education to starting a business. 2, for education-focused savings, if your primary goal is saving for college, right, or other education, 529 plans are your best bet. With their educational expense restrictions, they ensure that funds will be used for their intended purpose. 3, for early retirement planning, if you're keen on instilling the value of long-term saving and investing, consider a custodial IRA. It is a fantastic way to teach your children about retirement savings, even if it means that the funds are locked away for a long time. So again, which one should you choose? It depends on your financial goals and your circumstances. If you're planning for your child's education but also want flexibility, a combination could be the powerful strategy. As we wrap up, remember that 2020 is your year to take control of your family's financial future. Whether it's through an UTMA, an UGMA, a 529 plan, or a custodial IRA, start early and understand the options available to you. So comment below to share your thoughts or your questions, and don't forget to hit that subscribe button for more content like this. And if you're ready to take the first step, don't hesitate to reach out for guidance or check out my ultimate personal finance dashboard for more tools to manage your finances. Let's make 2024 the year we turn your financial plans into realities.